Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. Right now, markets are considering the ramifications of that U.S. military action in Venezuela and the removal of Nicolás Maduro as the country's leader. Bloomberg Intelligence is saying that Maduro's removal does raise the odds of higher non-OPEC oil supply, and that in turn reinforces an outlook for medium-term oversupply and limited upside for crude oil prices. Now, Venezuela holds roughly 1/5 of global oil reserves. However, the country accounts for just about 1% of total global output. China, by the way, is the largest importer of Venezuelan crude oil. For a closer look at market action, I'm joined by Viraj Patel. He is Head of Asset Allocation at Fiduciary Trust International. Raj, thank you so much for being with us. Give me your sense of what is unfolding right now in this Venezuela story, and how do you think we move on from here?
Well, a lot to unpack. Firstly, Doug, thanks for having me. Happy New Year and pleasure to be here. I think that you kind of nailed it initially. I think the knee-jerk reaction here for oil markets will be that crude prices should open down. We do have an oil market that is already oversupplied, and I think the initial market reaction or knee-jerk reaction is for global oil markets to have a little bit more supply, but I think that's a little short-sighted, and it won't be a light switch. Lots of implications, obviously. The U.S. is focused on the narrative or story of drug trafficking, and leaders in Venezuela are talking about U.S. seizing their oil assets, and obviously lots of cross-country and geopolitical implications, as the biggest beneficiary of Venezuelan oil is China. And they will not like the fact that U.S. could potentially be having some control. Maybe that's a little bit of an overstatement, but certainly an interest in the rare minerals, rare earths complex, along with the Venezuelan oil. But any type of restoration or meaningful growth or output from Venezuelan oil will take some time. It will take years and billions of dollars of investment. But as you noted, they do hold a sizable supply of proven oil reserves. So it looks to be kind of short term here, a little weaker for oil prices with prospects of more production into what is perceived to be an already oversupplied market.
Over the weekend, President Trump was saying that American oil companies will be spending billions of dollars to rebuild Venezuela's energy infrastructure. Is it too soon to get involved in a name like Chevron, for example, to kind of put some money to work right now in international oil companies?
I think it's tough to tell. I think a lot of these companies over the years or decades have also been burned in Venezuela as well. So I think that while Trump is likely right in the direction that there will be some U.S. interest or U.S. oil exploration and production interest in Venezuela, I'm not sure that American companies would head right back in immediately, because they have a lot of resource and investment already going on here stateside in the shale and light oil production. As I mentioned earlier, a lot of oil companies have moved out of Venezuela over the last 2 decades or so after being burned. And there's a different type of crude that's a little bit more heavy and viscous in Venezuela that requires a little bit of a different kind of expertise and equipment. So a lot of CapEx and equipment would be required, because this isn't a situation where you go into Venezuela with some experienced folks and just turn on the spigot, so to speak. Lots of really outdated infrastructure and assets and equipment that really need to be reinvested in. So I think it'll be a complicated story, and I'm not sure that oil companies from the U.S. will be running into Venezuela for what could be potentially billions of dollars of investment that could take upwards of 5 years and could be a low marginal return or a low margin story. So lots more to unpack over the coming weeks and months, obviously, but I'm not sure that anyone's going into Venezuela, at least from an oil company perspective, overnight.
Let's pivot to the macro story in the U.S. We get the employment data at the end of the week. How are you feeling about the American economy as we start the new year?
The American economy feels like it's on stable footing. We've been operating in a period of above average growth that's being held up by the U.S. consumer and consumption. So I think it's a tale of two halves here in the U.S. When you look at underlying sentiment and survey data, you get the idea that consumers are weak, that they're not willing to spend a whole lot, that they just don't have the confidence. But when you look at actual consumption data that comes out or retail sales data, you get a story where consumption is holding up quite well, and U.S. growth in aggregate is modestly above trend. Now, we would like to see a little bit more broadening of growth as we get into or head into 2026, moving beyond just a healthcare, technology, gig economy type of growth profile into one that becomes a little bit more broad-based and cyclical, that includes housing and manufacturing, which has been in the doldrums for a number of years now. So that's a story on macro. We think it's important for policymakers to keep financial conditions loose. Can't tighten a whole lot until you get confirmation that the other side of the economy that's a little bit more cyclical and interest rate sensitive is kicking into gear as well. We're just not seeing that quite yet, but we do feel confident that that is likely to happen in 2026.
So do current conditions, in your view, require or justify more rate cuts?
It'll be tough to see. So based on economic activity, I think it's difficult to justify more rate cuts, and policymakers and the Fed have been pretty clear about that. But they are seeing a little bit more downside skew, that is, in labor data, which has obviously been a little bit more noisy lately, right? We had the government shutdown. We had some of the Doge effects from when Elon Musk was under the administration. So from where we're sitting, the softness in labor market seems manageable. We don't necessarily have a view here that's recessionary. We're describing this economy and labor market as one that's a low hire and low fire economy, but no necessarily, we're not seeing any yellow or red signals that are firing from the economy as well. But we do expect it to move beyond AI, technology, healthcare into more cyclical areas of the economy as well.
I'm glad you mentioned AI, because I think for the market right now, a chief concern as we move into the new year is this issue of overinvestment in AI infrastructure. Bloomberg data indicates that combined capital expenditure this year from Microsoft, from Alphabet, Amazon, and Meta are expected to rise 34% to roughly $440 billion. And on top of that, OpenAI is committed to spending more than $1 trillion on AI infrastructure. Are we at the point now where we have to reconsider total spending?
I don't think we're there quite yet. So I think you make a great point in terms of the hyperscalers that are spending the biggest sums of money are subsidizing and fueling that spend from free cash flow. So for now, while the dollars of spend are massive, as you mentioned, on the orders of hundreds of billions of dollars, we would become incrementally more cautious and worried if there was a major term out of debt happening, right? So we're just seeing that in very earnest. Obviously, Oracle is the poster child. Some of their credit default swap spreads are starting to widen significantly. But other companies that have taken out debt is very marginal relative to their willingness and abilities. We're not quite worried yet. I think the important narrative for 2026 will be in terms of the direction of travel, maybe moving away from the hyperscalers, away from just the NVIDIA story, and the debate will be more focused on what are the companies that will benefit from using AI in terms of productivity, cost savings, and we think the AI build out will continue. And 2026 is more maybe a year of a strong debate in terms of how will these hyperscalers and companies start to monetize the massive amount of spend on AI, and will they earn sufficient the return on that investment?
How are you feeling these days about being exposed to markets offshore, particularly in Asia?
Yeah, we feel really constructive. So the broadening theme that I mentioned here domestically is more of a cyclical story related to manufacturing and housing, but you can really apply that theme globally as well, right? Europe, Japan, and non-U.S. markets, broadly speaking, had one of their best years in quite some time. We think that markets are well positioned for 2026 as well. We think that largely the story in Europe, Japan, and even China was one that was more driven by macro and policy. and it was right for these countries' equity markets to re-rate. And 2026 should be more of a story about corporate fundamentals and earnings growth. So the first time in a long time that 2026 earnings growth outside the U.S. has the potential to be low double digits or mid-teens growth as well. So that's Europe, Japan, China, and you can even throw India in there. So if we can get 10 to 12% earnings growth out of countries that have had really weak earnings growth, have done really weak relative to their U.S. counterparts, that could be a story that could set us up for another nice return profile in non-U.S. markets similar to 2025.
So given those various jurisdictions you just mentioned, I'm curious as to how the themes compare.
Yeah, it is quite a diverse situation. So I'll start with Europe, and I'll go eastward. So if you start with Europe, you've got obviously the debt brakes being lifted from a fiscal austerity perspective, and Europe has committed to spending $1 trillion over 10 years. So I think the beneficiaries there are cyclical economies, industrials, materials, infrastructure, and obviously aerospace and defense type of companies. They obviously don't have the sectoral composition like the US, where you have a lot of technology companies. So think of that as more of infrastructure, aerospace, defense, energy now. When you move further east to Japan, I think that's more of a broad-based recovery as they've experienced reflation for the first time in 40 years, but maybe more of a technology focus there, given their demographic issues, given some of the work that the new Prime Minister Takehachi is undertaken. So a little bit on robotics, a little bit on engineering, a little bit on AI. Obviously, with the yen trading at some of the weakest levels we've seen in some time, their export base and manufacturing should kick into gear. And then when you go into China a little bit, we think it's a little bit of a barbelled approach. We certainly need to see real estate and property prices need to stabilize there for them to really recover. And then on the other side of the spectrum, you have a consumer confidence, which is really weak, right? Because wage growth hasn't been that great. And a lot of consumer savings are locked up in property and real estate markets, which have done really poorly over the last 3 to 5 years. So we'd like to see some kind of fiscal stimulus, kind of kick in animal spirits in China that can boost consumption for the middle class and then permeate through real estate markets. So a little bit of a different kind of approach in all the different economies or jurisdictions, as you mentioned. And India, not to be left out, is a really kind of broad base. So they're kind of firing on all cylinders from the top down, bottom up, and you have the financial sector that's doing really well, technology that's doing really well, industrials, infrastructure, materials. So a little bit of a different story in different economic blocks and countries around the world, but one where we feel they could all benefit from what we're describing as a global synchronized recovery in 2016, using the 2025 momentum and strong macro backdrop as a foundation for growth into 26.
Okay, Raj, we'll leave it there. Viraj Patel is Head of Asset Allocation at Fiduciary Trust International, joining us here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Over the weekend, Beijing said it was deeply shocked by the U.S. military strikes on Venezuela and the capture of President Nicolás Maduro. Now, China is not only the biggest buyer of Venezuelan crude oil, it is Venezuela's largest creditor as well. We got some perspective from Alicia Garcia Herrero. She is the chief APAC economist at Natixis. Alicia spoke with Bloomberg TV host Paul Allen and Avril Hong, and the conversation began with a question on the ramifications of the U.S. military action in Caracas.
China has had it still has very large commercial relations with Venezuela. At the highest end, of course, Chinese oil companies, state-owned oil companies, and this is really what is behind those 60 billion loans that started right before the global financial crisis in 2008. It's not very clear, though, that China still has basically a loan of 60 billion. The most likely scenario is that this loan has been reduced by basically sizing Venezuelan assets, part of which are oil-related, upstream-related. Sinovenza, for example, is a JV between PDVSA, the Venezuelan oil company, and China. So probably China has more equity now than actual loans, in my view. But the reality is that all of this equity means that the relations, even human relations, are huge. Yeah, I mean, beyond the upstream oil, there's a lot of other sectors, construction, you name it. Also because Venezuela invoices all of its oil, which is more than 90% going to China. Around 4% of Chinese imports of oil come from Venezuela, 600,000 barrels a day. But all of that for Venezuela is all it has in terms of exports. So it all comes in RMB. And that means that anything that Venezuela needs to do in terms of, again, construction, imports obviously come from China. So it is a very, very important relation for Venezuela. And in some way, it is also important for China, although obviously at a lesser extent.
Can you talk to us a little bit as well about the implications of the events we've seen in Venezuela over the weekend for global risk appetite? Because at the moment, early stages in Asia on Monday, really markets seem to be just shrugging this off.
Yeah, well, markets shrug everything, as we know lately. I would say since Trump came to power, any geopolitical event, and by the way, let's not forget North Korea actually tested missiles as we speak, and nothing happened. So, we also have the North Korea risk at a time where, the South Korean leader is visiting Beijing. So you can't understand markets. As far as geopolitics are concerned, they're just shrugging off everything, as I mentioned. But I do think it's important because there's two things here that relate to Asia. One is, of course, Taiwan. How will China read Venezuela? There's two readings. One is, nobody's going to tell me that I shouldn't do whatever I may have to do. But secondly, it could be fear. Yeah, the U.S. has proven to be pretty targeted in terms of reaching a leader, taking away a leader. I mean, that's not something that is easy to do. So we don't really know how China will read this in a way. There's two readings in my view, and we still need to see what will unfold. Will the U.S. basically bring Venezuela back to democracy, or just profit from a non-Maduro type autocratic state in Venezuela? If the latter, that opens the door to potentially other events in Asia, in my view. Whether it's Russia, there's many things that could happen that are negative for markets that we may not be reading yet.
Alicia, as you allude to, it seems like the takeaway here is we are moving into a more fragmented world, not just developments over the weekend, but in the past year. What is that going to mean for the current ongoing realignment of global trade, and how does that actually impact the outlook for Asia economies?
Well, the story here, I think Trump 2.0 was, Trump comes with tariffs and we're going to basically get closer to China in terms of trade because that's what ASEAN has been doing and that pays off. Yes, China is still today importing too little, but at least it's a non-tariff related market. We don't need to be forced to invest in the US. That was the world up to the beginning of this year. I think this event in Venezuela shows that that's not going to be so easy. Yeah, if you get too close, if you become a vassal state of China, which is what Venezuela was, maybe with some hints from Russia. Russia also had $6 billion actually lent to Venezuela when China was at the peak, $60 billion. So that combination, maybe you don't want to be there, and that is what we've learned here. So it is fragmented, but it's riskier. It's not only about trade. It's not only about tariffs. It's not only about forced investment. It's that you may end up losing your power if you're a leader. So that means that taking sides here, as was happening before, could become riskier and more expensive. That gives the U.S. a little bit of a hands up, but only if the U.S. handles this well, which is very unlikely, to be frank, because because this is a very messy situation.
What about your assessment of the extent in which, going forward, this realignment, how exactly is that going to benefit some of these economies in Asia that are perhaps more tech focused? Given to Paul's point, they seem to be overlooking or looking past these geopolitical developments.
Yeah, that's right. I mean, when we look at Asia's performance in 2025 is basically exports, which is ironic given the tariffs. But it is because the U.S. demand for Asian exports, and especially tech-related, at the highest end, that's Taiwan, basically close to 100% increase in exports, mostly to the U.S. And then even Malaysia, whether it's AI chips packaging or other types of chips for that matter, lower end, even Chinese exports of chips beyond the U.S. obviously elsewhere and maybe re-exported to the U.S. All of that is a story that has nothing to do with the geopolitical situation. And that's why we see this shrugging off. It's because the market is still on AI and tech, while the world is in Venezuela. And Venezuela has no tech. So, there's no link. But for how long can you keep that disconnect? I would argue that you just need to see something related to Taiwan, and then things change, because that's the origin of all of these high-end chips, which everybody needs, including NVIDIA. So, the relation with the stock market would clearly change if we saw any signal that Taiwan is at risk.
All right, Alicia Garcia Herrero, Chief APAC Economist at Natixis. Thanks so much for joining us.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.